Talking about ETFs for several years now. He thinks they're a really good opportunity for small investors who don't want to eat up a lot of their money in the fees and stuff like the big guys can afford.
Or eat up your time trying to understand companies, because there are people who do that for a living. And when these markets jump around like they've been doing, it's kind of tempting to do what everybody says you shouldn't do and start messing around in the wrong way with your retirement investments or your 401ks.
But certified financial planner Doug Flynn thinks this might actually be a good time to tweak your allocations based on your age and how much risk you can stomach.
Doug is with Flynn Zito Capital Management here in New York. Doug, good to see you. Thanks for being with us.
Thank you.
Interesting world in which what Joe Moglia, who runs a big trading operation, says you should do, and what you say you should do, it's both the same thing. Sure. You have to invest in a way that you can manage, whether it's because of your risk or because of your time that you can spend understanding it.
That's exactly right. What you need to do is have a portfolio that you can live with for the long term. And these types of gyrations in the market are good times to test whether or not the allocation you have is still good for you.
Well, I think a great point, too, is that if you're freaking out right now about what your allocation is and you haven't been doing your job, which is to have an allocation, so if something like this happens, you are comfortable with where you are and you can reassess things, right? I mean, if I suddenly have been really aggressive and now I'm feeling very conservative, I should have thought about that.
Yes, and in the last couple of years with the market doing very well, it's easy to even allow your portfolio to get more and more in stocks as that's grown.
Right.
The bonds have grown slower, the stocks have grown faster in the last 4 or 5 years. So all of a sudden there's a downturn and you might not realize that you're, even though you're aggressive, you might be more aggressive than you even wanted to be. So these are times to gut checks to say, you know, this may or may not be the same allocation that I had, and maybe I should make some adjustments.
All right, there's two kinds of people in the world, those who are under 45 and those who are over 45. For purposes of you out there, if you are under 45, you're over 45, just sit tight, we're going to get to you in a minute. If you're under 45, you can be, as Christine said, conservative, moderately aggressive, or moderately conservative. Let's talk about this. Going from moderately conservative to moderately aggressive, what should your portfolio roughly look like?
Well, that's the first thing, is to make sure that you understand just what your risk tolerance is, and you can do that online with some online tools to identify it.
In many different places, many different websites have
exactly. But once you identify it, what you want to do is that obviously a moderately conservative investor is going to have less in stocks than someone who is more aggressive. And when you're under 45, that typically means that you've got roughly 20 years to save for retirement, especially in the area of your 401k, where you're every week off your paycheck adding money in and buying through the ups and downs. You can be a little bit more aggressive generally, but just because you should be a little bit more aggressive because you're younger doesn't mean that you still have the stomach for aggressive investing. So we kind of break it out, even though you're young, to still different types of risk levels, and the idea is just to have something in the market. You want to have as much as you can feel comfortable
So
with.
even if you're conservative, you're still saying more than half your investment should be in stocks?
Yes, because if you think about being, let's say, 40 years old, people think when they hit retirement that that's it, it's over. Really, it's just the first day of the rest of your life. So if you live 20 or 30 years into retirement, when you're 40, you might have 50 years of investing in front of you, and over those kinds of time frames, you should have as much in stocks that you can, or stock mutual funds and ETFs.
If you're under 45, so you've got all this time, you can work, you've got all this sort of time horizon. If you're over 45, you're closer to retirement, you have to start kind of dialing it back a little bit.
Exactly. That's sort of one of the model time frames to take a look and say, okay, I'm now within 20 years of retirement.
Although when I do those calculators, I say I want to retire at 55, and I want this percent of my, and it always goes big red lines. Well, it does not compute.
Yeah, it's not going to happen. Yeah.
So I think it says I have to work till I'm 82 or something.
But Doug's advice, it doesn't really matter what it tells you. Just do it. Start doing it.
Right.
You know what I mean? It might not seem great.
Yes.
But if you are over 45, it's more important that you pay attention to this. And what are you telling people if they're going from moderately conservative again to moderately aggressive?
Yeah.
What should those divisions
It's
look
usually
like?
just one step back. So your age, in your example, if you're going to retire at 55, you're actually only 10 years away. So you need to dial it back a little bit and get a little bit more conservative. That doesn't mean get out of the market, because you still have a long time, but it means it's one step closer. And I think too many times people take a look at their portfolio and try to get in when it's high and get out when it's low, when really this is about setting up a portfolio that you can live with long term. But ideally, you're going to get a little bit more conservative slowly as time goes on and as you age, and that's the lesson here.
And there's a great way, I mean, there's so many tools out there to be able to do these computations online, as you said, or someone can go to a place like TD Ameritrade, or they can come to someone like you What do? Do you do those computations and then you tell them what to invest in?
Absolutely. One of the first things you do is assess risk. What's the risk tolerance of someone? And then you talk about timeframes for their goals. You know, with all the stuff that's going on in the markets, there's always stuff going on in the market. So if you think long term, and it's hard to do that because money is a very emotional subject and people tend to react emotionally, this helps you stay a little bit more objective. And if you can do it yourself, fantastic. But that's what advisors do too, is they help you try to stay with the long-term picture and remain a little objective.
How do you consider yourself? I mean, I would not consider you as a conservative person in any manner, so you wouldn't be conservative with your money.
As you guys talk about it, it's a gut check thing. I mean, do you like mini golf or do you like roller coasters? You might think that you want to be retired at 55 with $5 million in the bank, but what do you feel comfortable with? I definitely am much more of a risk taker than I should be.
Now, I'd like $5 million in the bank and retire at 55, and none of the calculators can get me there.
Yeah.
Now, I need someone to invent the calculator that's going to get me to 55 retirement.
It's called the stock market.
Yeah. And it's the input, how much you're putting in.
You got to save a lot, and that's Doug's one point. We should talk about this a lot more. Is you can't get out of the market entirely.
And that's a natural reaction to want to consider doing that. But when you peel back all the subprime and you look at the fundamentals of the economy, whether you go back 20 years ago with the stock market crash, or 10 years ago with long-term capital management and all that stuff, or 2 years ago with Hurricane Katrina, you look forward and the market keeps doing what it does over time. So these things are natural, assuming it doesn't turn into something truly disastrous. But when you look at that, you say, well, my goals are 20, 30 years out. I'm not worried about tomorrow, and that's what you need to pay attention to.
All right, Doug Flynn, thank you so much. It's always so great when you stop by.
Thank you.
All right, Flynn Zito, thanks. All right, coming up on Your Money, how you could lose your home insurance if you're in a high-risk weather zone, and what a sports scandal like the Michael Vick dogfighting case could cost the NFL and other professional sports.